Before we get started, make sure that you subscribe to this channel. That way, when I release more content like this, you'll get notified. Welcome to my video on how to prepare a cash flow forecast. Imagine this is an aquarium. To keep the fish alive, it needs water. If all the water flows out, the fish will die. This is the same for a business. If there isn't enough money coming into the business and there's a lot going out, the business will not last. The money coming into the business is inflows. In other words, it's income. The money going out of the business, the outflows, is called its expenditure. So let's have a look at income and expenditure. The income, as we know, is money coming into the business. This could be in form of sales, so either cash sales or credit sales. It could be from loans from the bank. It could be capital introduced. Capital introduced is another word for money put into the business, and this usually comes from the owner. It can also be called owner's capital. The sale of assets, if the business sells something, for example, if it has some delivery trucks and it sells one of those trucks, then that would be a sale of an asset. Bank interest received as well. If the business has money in the bank, it will receive interest on that money, and therefore that is classed as an inflow, so income into the business. There are others, but these are a few examples. The expenditure are the outflows of the business, what's paid out. They come in the form of purchases, so either cash purchases or credit purchases, and these tend to be things like raw materials. There's also advertising, rent, salaries and wages, electric, water and rates. And again, there can be others, but these are examples of sorts of expenditure that a business will have. The question then comes is, how often do you prepare a cash flow forecast? Well, this depends on your business. You can prepare an annual forecast if you wish, but if money is a little bit tight, you might prepare a weekly or a monthly forecast. If you prepare one weekly or monthly, you can adjust your annual forecast accordingly. There is no set rule for when you can prepare a cash flow forecast, but you would tend to prepare one more regularly if money is a little bit difficult. For example, you have fluctuations in your year's cash flow. You may wish to prepare one weekly to make sure that the money you have coming in can pay for the things you have going out. So let's have a look at the top part of the cash flow forecast. You start off with the opening balance. The BF in brackets there is brought forward. That means it's been brought forward from a previous month. So in this scenario, the £1,000 shown in January would have been the closing balance at the end of December. So what you finish December with, and therefore what you start January with. Your income is the sales, so this is the total sales, both credit and cash sales, so that's your income coming in. And the bank loan, this would only be here if you have taken out a loan. You can also add another line in there to include things like capital introduced, so if owner's capital, bank interest received, etc. And the total inflows is your income, so you add together all the money that has come in. But be careful, do not include the opening balance, as this is money you already have. So let's now look at the bottom part of the cash flow forecast. You'll notice you have a line there called expenses. You don't have anything in that line. That is simply a title introducing that you're now going to be talking about your expenditure, so your expenses. You'll have your total outflow, so the expenditure. You add together all the money that has gone out, so what you've spent. We then look at the net cash flow. So net cash flow is what you have in your hand, what you are left with after receiving all income and paying out all expenses. And the formula for net cash flow is the total inflow, so total income, minus your total outflows, which is your expenditure. The closing balance is the amount you finish the month with, so what is in the bank account. And the formula for closing balance is your opening balance plus your net cash flow, which will give you closing balance. The CF in the box there underneath closing balance is carried forward. So whatever appears in your January closing balance becomes your opening balance for February. So let's have a look at the whole cash flow forecast. We start with our opening balance, which has been brought forward from December, which is £1,000. We then look at our income. So we have £8,000 from sales and we have £5,000 from the bank loan. We then add those together, which gives us our total inflows of £13,000. We then look at our expenses. We had £2,300 of purchases, £5,000 of wages, £850 of heat and light, and adding those together equals £8,150. We then look at our net cash flow. We know the formula for net cash flow is our total inflow, so our total income, minus our total outflows, so total expenditure. So we look at our 13,000 as our income, so inflows. We minus off our total outflows of 8,150, which gives us 4,850. We then conclude with our closing balance, what we're left with at the end of the month. We can see there that we have 5,850. How's this made up? Well, we look at our opening balance of £1,000. We add our net cash flow, and that equals 5,850. What we then do is we carry that closing balance forward, so carry forward into our opening balance for February. So the February figure in our opening balance has been brought forward from January. Here is a blank cash flow forecast. Have a go at completing it with the information provided on the next slide, and then we'll have a look at the answer. Our business is run for the sake of this example by Sebastian, and Sebastian has provided you with the following information. He had £2,700 in the bank at the end of December. The sales for January were 26,000, for February 16,000, and March they dropped to 8,000. He invested 2,500 of his own money in January, so owner's capital or capital introduced, and then in March he took out a bank loan for £4,000. His expenditure for January was purchases of 15,000, utilities 3,000, telephone 1,200 and wages of 6,000. These then dropped in February to purchases of 9,000, utilities of 2,000 and telephone of 1,200. The wages were 4,000. His expenditure dropped again in March with purchases at 6,000, utilities 2,000 and telephone 1,200 and wages 4,000. We now need to put these in our cash flow forecast. So let's have a look at the answers. We know from Sebastian's figures that he had £2,700 in the bank from December. So that now becomes our opening balance. We've brought it forward from December into our opening balance for January of 2,700. We then look at our total income, which is 28,500. We get to that figure by adding our £26,000 of income to our owner's capital of 2,500. We then look at the total expenditure. If we look at our purchases, our utilities, our telephone and our wages, if we add those up, they come to 25,200. Next is our net cash flow. Well, the net cash flow is what you have left in your hand that you want to put in the bank. This is calculated by taking our total income minusing our total expenditure. So in our case, 28,500 minus 25,200 equals 3,300. We then conclude with our closing balance. How do we get our closing balance? The formula is opening balance plus net cash flow. So in January, our opening balance was 2,700. We then add our net cash flow of 3,300, which gives us a figure of £6,000. We then take that closing balance and we carry it forward to February. It then becomes our opening balance. And you'll recall that the brought forward is from the previous month. So our opening balance of £6,000 has been brought forward from our closing balance in January. We then look again at our income. So we only had £16,000 from our income from sales. So that's all we put in that box. We then look at our total expenditure, which comes to 16,200, which is adding up again all the expenses. We then look at our net cash flow. which is actually a minus figure. The reason it's in brackets is because bracketed figure is much easier to see than just a dash to show that it's a minus figure. I've put it in red for illustration purposes. How do we get to this negative position? Well, we take our total income of 16,000 and we minus off our total expenditure, but you'll notice that we've spent more in expenditure than we've had come in, which is why we've got a negative figure. We then look at our closing balance. You'll recall that closing balance formula is the opening balance plus your net cash flow. Well, your opening balance is 6,000. We then need to add on a negative, which is the 200. So technically, we're minusing that figure. So 6,000 plus minus 200 is 5,800. We then carry that forward figure of 5,800 over to our March opening balance. So again, that 5,800 has been brought forward from February. And the same thing again, we add up our sales and our bank loan, which gives us our total income of 12,000. We then add up our total expenditure for purchases, utilities, telephone and wages, which comes to 13,200. We then get to our net cash flow, and again we seem to have spent more than we've had come in, so our expenditure is higher than our income, because we take the 12,000 income, we minus off the expenditure of 13,200, which gives us a minus figure of 1,200. We then get to our closing balance, and again the formula is our opening balance plus our net cash flow. In our case, 5,800 plus minus or negative 1,200. Therefore, we have to deduct it. So that comes to 4,600. So let's have a look at the advantages and disadvantages of cash flow forecasts. A cash flow forecast is used by businesses to try to predict the flow of money into and out of the business. If a business uses cash flow forecasts, they can try to identify where there is a shortage and either prevent it from happening or have plans in place to deal with it. When we refer to shortage, it could be the lack of money coming in, or it could be a massive amount of expenses going out, and we want to try and prevent that from happening. Therefore, we may want to try and increase our sales by further advertising, or we may try and reduce our expenditure by having a discussion with our suppliers as to whether we can come up with any lower prices or gaining benefits from bulk buying, depending on what our expenditure is. Problems can occur if expenditure is higher than income, as we saw with Sebastian in February and March. His expenditure was much higher than his income, and therefore he had a negative net cash flow figure. At the moment, it hasn't really affected Sebastian because he still remained in a positive closing balance figure. But if you have a look back after this video onto the closing balance for March for Sebastian, the only reason he's probably in that position is because he took out a bank loan. And the one thing you can try and avoid with cash flow forecasts is supporting your business by way of loans, because they have to be repaid. Forecasts are just that. They are a forecast and they are predictions. They may be based on information from the previous months or years, but things can change. The actual flow of money into and out of the business needs to be monitored alongside the forecast. Very few businesses in reality have consistent cash flows throughout the year. They are likely to experience busy and quiet times. Seasonal businesses are a prime example of inconsistent cash flows. Take, for example, a bed and breakfast in a seaside town. The majority of their income would come in the summer months. However, for the rest of the year, they still have to pay rents and rates and utilities, so the fluctuations in their cash flow forecast will be more severe. I hope you've enjoyed my video on cash flow and understand cash flow forecasts and how to put them together. If you like this video, please make sure that you click like and subscribe to my channel. Thank you for listening.